Oh, welcome, Ryan.
Thank you.
It's going to be me and you mostly. The host is like Robert. I'll introduce you to him a bit later. So we're gonna have a little bit of a discussion, mostly about building a resilient kind of portfolio for these kind of times. So perhaps we would start by. I mean, the speakers also the attendees also don't know me that well, so I'll perhaps start by introducing myself, then I introduce you, and then you can speak a little bit. My
Okay.
name is Eric Mokaya. I stay in Sweden. I'm a Kenyan. Very proud. I'm wearing a Kenyan kind of made shirt here. And I've been here 5 years, but I've been doing investing in the stocks, I think in the US mostly for the last like 4 or 5 years more consistently. So I'm interested in US markets. I read a lot of the transcripts, especially from earnings calls a lot. So I'm a student. I'm studying my PhD soon in Sweden. So basically, that's just about me. So maybe Ryan, you're the guest today. So you tell us a little bit about yourself and what you do, and maybe a thumbnail sketch of who you are.
Yeah, great. Well, first of all, thanks for having me. So I started a company called Investing City about 2 years ago, and the kind of tagline is helping investors save time and boost returns. So we're just a research service that kind of provides all the grunt work for investors and just the deep research to make sure that people know exactly what they're buying and why they're buying it. And have a few other little newsletters and pretty active on Twitter, and that's where I met Eric here. So really excited to be on, and thanks for having me.
Welcome, welcome. So tell us a little bit about Investing City. By the way, you're very young, right? You should shock people how old you are and how long you you've been investing.
Yeah, I mean it's kind of random, but I've been investing since I was 12 years old. So in when I was very young, I had a teacher who brought her husband in and taught the class about investing, and
Yeah.
for some reason I just found it really fascinating and kind of latched onto it and just started investing over time.
Can you tell
So
us a little
yeah,
bit about that story? I like the story because I've heard it before, but I would love the rest of the people to hear it.
yeah, sure. So it was kind of like so everybody was 11, 12 years old, and this teacher brings in her husband after school and just kind of, if anybody can make it, her husband's teaching a little class on the stock market, and I could make it, so I was there, and we did a little competition where we would pick one stock and follow it throughout the year and see who did the best. And I picked McDonald's, and it didn't really do that great. And this girl sitting next to me picked Apple, and she like crushed it, did so much better than everybody. And I was like, hey, why did she do so great, and why did I not, really do that well? And just kind of digging in and figuring out that question was honestly a big source of why I was interested so early.
Hmm. So now how did you end up? Do you study finance? What do you do now presently? Like you manage, is investing city like your full-time profession, or do you have something on the side also?
Two paid products. We have the Dynasty membership, where people get everything. We have a financial course, little breakdowns of different businesses, and then access to our full portfolio. And then we have lower priced business breakdowns, where twice a month you get a business. Like the tagline is like a 10K, but if infinitely better. So we read a bunch of annual reports and then just try to synthesize the information as clearly as possible to just show investors different business models. But yeah, it's full time right now, which is it's amazing blessing.
Okay, and you started it only 2 years ago, right?
Yeah, it's been about 2 years, just over 2 years.
How has been the growth journey? How do you get new subscribers? What's the feedback you get? Which companies are people more kind of interested in so far?
Yeah, that's a really good question. So I've just tried a bunch of different ways to grow it. Like we started a podcast, and that has been a very long process of probably not until a year and a half. Somebody said, "Hey, because I was listening to your podcast, I subscribed." So it just takes a long time to get familiarity and kind of become a trusted source. But Twitter is a great resource. You just have website. in my bio and just try to provide a bunch of valuable information. Tried YouTube videos. I originally started out writing for Seeking Alpha, so just doing stock articles and just writing a ton of them, and that seemed to help. So just kind of trying a bunch of different stuff and see what's sticking. In terms of which companies people are interested in, it's kind of tough because it's kind of the companies that I'm interested in, and
Which ones are this currently? Which is your favorite company? Tell us a little bit so that we can we may join you in investing in it.
That's a good question. So there, I mean, the thing is, valuations have definitely gotten much richer, and this might not be my favorite, but I'll give you one. There's this company called Livongo, and it's a remote monitoring company, and it was kind of difficult to understand originally, but this company IPO'd and the stock price got up to about 40, and then it quickly started dropping on really no news, and it got all the way down to 18. And so I did a deep dive on this company, and it's pretty interesting. So the guy who started it, his son had diabetes, and he wanted a better way to kind of help his son through this process. And so they contract with employers. So let's say, for instance, I know Pinterest was at one point one of their customers, and so everybody who works for Pinterest who has a chronic condition right now, they service diabetes, hypertension, and weight management, and they term those chronic conditions. And so every Pinterest employee who's interested in that can opt into this program, and then Pinterest will pay Livongo based on the amount of members or the amount of employees that actually opt into this program. So that's how they get paid. And then the actual business is, once somebody opts in, Livongo will send them this kit, and it has a glucose monitor and just all of the stuff that they will need to kind of monitor this condition. And what's interesting about these monitors is they're actually internet connected. So you can take your glucose, and that information is immediately sent to Livongo. And the whole thing is that there's a bunch of data behind this. So all of this data is transmitted directly to Livongo, and if there's something wrong, they have what's called these nudges. So they actually have a team of people who is caring for all of their customers and their members. So if something is crazy off, they'll basically send like an automatic text message and say, "Hey, this is your insulin level should actually be here. Maybe you can do this and this." And so it's kind of prescribing what exactly you should do remotely. And it's interesting because people with chronic conditions historically have much higher hospitalization costs. You know, if they have to go in, if their blood sugar gets really out of whack, and that causes high costs for employers. So the value proposition for employers is that Livongo's system will actually help them save money. And the whole thing is the clinical outcomes. It was kind of hard to get like a true understanding, because sometimes companies are way more enthusiastic and think they have this great product, but actually in the real world it doesn't seem so great. But I found that Livongo, it seems like the outcomes of health are actually really good, and the company is growing very quickly and has pretty solid operating leverage, where they're currently losing money right now, but the losses are getting much smaller as a portion of revenue. The founder, he's now the chairman, and he brought in a very professional CEO, but the founder is very much involved. Unfortunately, diabetes is a giant market, but Livongo is really, it's just starting in this journey. So I think it's a pretty interesting company.
So basically, then I would ask you, like, how do you, because most of our listeners are from Kenya and they're interested in the US market, how do you get started on investing in a company? Because if you look at the entire stock market, I think in the US, I think it's around 17,000 companies to check out. So every week I try to read transcripts, and the maximum I can read on a normal level like could be 25 at most, and that's a lot of work. It takes a lot of time. So like you need to start somewhere. So for someone who wants to start investing, what would you advise them? Where should they start, so to speak?
Yeah, it's a great question. I think a really important thing is understanding something called a circle of that you have a really in-depth knowledge of or that you're interested in. That's kind of how I would personally define that. So, for instance, let's say you just are really interested in technology companies, you maybe do software engineering on the side. So, that would be like a natural place to start because you understand kind of what the company does and how it functions versus if you see, an oil stock and you've never looked at an oil stock, you have no idea exactly how they work. That would be a much, much more difficult place to sort of have an edge in. So even if it's a company that I think like a great place for investors to start is see and we use on a daily basis. So I
Like
think a great place to
Colgate.
start. Yeah,
Colgate.
exactly. Like just go through every product that you use and make a
Good.
list of it. And there might be, products that you would have no idea the company that actually makes it. But once you look into it, you can find out, like, oh, Colgate is this great company, or, my shampoo, if I actually look on the bottom, it's made by P&G. What's P&G? Like Procter and Gamble. So like all of these things and products that you use, maybe you go
Your
on
bank
Facebook, maybe
account. The
yeah,
bank
exactly.
account.
There's so many different things.
Yeah.
I use WhatsApp or I use this other messaging system. WhatsApp's actually owned by Facebook. All of these things, maybe Google. There's just like a lot of places to start with companies that you maybe interact with. So then you have an understanding of the business and how it works. Because I think that is an incredibly underrated thing versus trying to go into these industries that you really have no clue about.
Yeah, I agree with you because, as you say, like we should start map out your day and see which kind of products are you using and where do they come from at the end of the day. So, for instance, now like Zoom, we are currently using it, so I think it's
Yeah,
a
we're
good
using it
place
right
to.
now.
So, like, what exactly? How does Zoom make money from all these like conversations that we had so far? So, I would want to also pick up there and just go. You did a podcast the other day about companies whose names have become kind of part of the dictionary. I liked that the podcast that you had. Could you elaborate a little bit about it and how that also links to what you just said about taking companies that you understand, and then taking from there to companies that actually now move from there and now become part of our vocabulary. So we no longer say let's Bing it. We say let's Google it. Something like
Right.
that. Not no Yahoo anymore. It's Gmail or something like that. So like how do you take those now? How do those kind of companies then leave a certain imprint in people's lives in such a way that their revenues are actually sustainable for the long term? How do you
Yeah,
think
I
about
mean,
that?
I think you hit on it. It's a really interesting phenomenon when a company actually becomes a verb. So I've just noticed kind of over these past couple months with, a lot of video conferencing going on. It used to be like, let's Skype it or maybe we'll FaceTime, but now it becomes, let's Zoom it. So it's pretty interesting when a company becomes a verb. It's like another level of brand strength. It just seems like there's so much mind share, and I think mind share is actually like an underrated part of a company, because like a lot of people are thinking about this company and it becomes in the sort of vernacular vocabulary of modern day.
Mhm.
And I think that's actually underrated because um, there's so much brand power behind that like you said, it becomes almost like a reinforcing cycle, and it becomes pretty sustainable. So like I know all over the world now, Uber is becoming much like it's obviously incredibly popular. Let's grab an Uber versus. And the other interesting thing is even between Uber and Lyft, like I've had people say let's get an Uber, but then they actually order Lyft. So it seems
Yeah,
like
that's true.
Uber is like actually like a very strong
It's yeah,
kind of brand,
it's it's
which
it's
the
kind of
thing is
funny
it
those
doesn't
kind of companies. Yeah,
the thing is they don't always work out. Like Lyft and Uber have definitely a lot of competition in the US, and so Uber is still losing a lot of money. But it would be interesting to look back, like if we fast forward 10 years in the future, will Uber actually be like very successful because of that fact.
Mm.
So yeah, there was like a few other ones. Like I think there's this company in the US called DocuSign, and anytime you digitally sign a paper, I know in real estate, if you've ever been in real estate, then you always use DocuSign, it seems like. So that is becoming a verb. And there's just a few others. I mean, Google,
Yeah, Google's.
and I know Amazon. Like if you buy it off of Amazon, even if you buy it off of Walmart.com. So it's just kind of interesting, just something to think about.
So maybe I'll give perspective. In Kenya, we have this kind of margarine product. It's called Blue Band, and because everybody growing up knows Blue Band, so whenever you want to ask for any other margarine, you say, "Could I have the Blue Band of this other
Oh
company?"
yeah.
So it's like this company. It's like, can we Zoom on Facebook or something like that? Something.
Right.
So that would be kind of. But then, how do you move? Let me ask you the next question. How do you move from now? This is a company I want. I use it. Say Apple. I use Apple products. You use Google products. You use all these Zoom products. How do you move from there to now understanding the company? Where do I get the information from? Like if I mean, they of course there I could look at the phone I'm using and see how much data I consume or something like that. For Kenya, that would be Safaricom, a very big company there. But then how do you move from there to understanding the company? Because there is a step there. There is using it, and then there is understanding the company and what drives the company, right?
Right, exactly. I think that's a good insight, because the first question was, how do you narrow down this universe? And so we've looked at the products that we maybe use, and we get this sort of pool of companies that we're familiar with. And then exactly right, there's this next step of actually researching the company. And this next process is pretty interesting. You kind of, I think an underrated piece is kind of letting your curiosity lead you. And so the first thing that I will do is pull up the 10K, or
What's a
that's
10K?
also,
Because the
yeah.
what's a 10K? What's a
So the 10K is also known as the annual report.
okay?
So in the US, it's called 10K, but in Europe, it might be called the 20F. And so there's different names for it, but it's the annual report. And if you're a publicly traded company, meaning you've IPO'd at one time, you've actually gone public, then you are required to kind of file an annual report every year. And so I think you can find this, probably a pretty reliable place globally, is type in the company name on Google and then investor relations. And so it'll bring you to investor relations site. And then once you go there, you can navigate to sort of find the annual report. It might be SEC filings or financial information. There might be a few tabs. But once you locate the annual report, it'll be this big long document, and it'll be kind of scary to read.
Yeah.
But really the two sections that I think are important are the business section. So there will usually be a table of contents, and then it'll say business. And you can just click business, and it will be like a hyperlink, takes you exactly to that section. So the first piece is you want to understand exactly how the company makes money, because if you don't understand how that process happens, you want to understand when something changes, or when when the business starts deteriorating, you won't have any context for why that's happening. So that's the first section, understanding how the company makes money, sort of the industry background. And then there's another section that's the management's discussion and analysis. And
What's inside that management discussion and analysis part?
So this is a little bit more zoomed in. So it will take you and kind of help you understand what exactly happened in the past year, why this company is growing the amount it is. It will just give a little bit more detail on sort of the components of the business. And so that's really important. And then once I read those two sections, I will actually pull up a Google Sheet and transfer all the financials. So there's a couple websites out there. There's one called stockrow.com that I don't know how great it is globally, but you can find the information directly on the investor relations page. If you go to the quarterly reports, so a company 4 times a year has to issue earnings, and they will have all of their financial information in those earnings releases. So what I'll do is transfer all of the financial information, primarily revenue, gross profit and earnings. So usually earnings before interest and taxes, otherwise known as EBIT. So I think those three things are probably the bare minimum if you just transfer them over. So if you did like the past 4 quarters, that would be actually 8 data points, because in the earnings releases, it'll do the latest quarter and then the year previously. So I just record that quarter and then the year previously for those three: revenue, gross profit, and EBIT. And once you do that for the last 8 quarters, you have a little bit of a trend line. And so you can understand, like, is revenue really decreasing? Is the company's profitability really decreasing? Or is it increasing, which would be great. So you can kind of see the trends in the financials and then sort of triangulate that back with the 10K and start understanding why that's happening. So it's a really nice blend of financials and then actually the business understanding of why this is happening. And so that's like really a big chunk of the research process.
Okay. And then once you've done this, now you've understood a little bit about the company and what drives it. Are there other places you go for information, maybe? Because perhaps the information that is in a 10K, everybody kind of knows about it. Actually not. I've actually realized a lot of people don't even read the annual report. So actually you have an edge by just reading yourself on your own, kind of. So I would not say like everybody knows about it, but where would you get some additional information, like to put into this bowl of soup so that you're making this food? So you picked up some salad and stuff like that. So what can we add to this so that we have a nice little dish so that we can serve at the end of the day?
I love that. Yeah, what can we add to our research dish?
Yes.
Yeah, there's a few
So we
things.
have the annual report inside. Now, let's add something.
So I think the management team is really important. And this, I mean, the thing about this is kind of what I started with, just letting your curiosity lead you. So first you can find out, you can even type in the company name and the CEO, and you can find out who he is. And then you can Google him, and maybe he has a few YouTube interviews, maybe he's done a podcast, maybe he's written a book. So just kind of letting your curiosity just lead you to all of these different information sources and just finding out about him. What's he like as a person? What's his track record? Has he founded other companies before this? Does he have a great strategy? How much of the company does he actually own? So there's another document called the proxy statement. And you can find that on the investor relations page as well. And that will show you what's his or her salary, how much do they actually own of the company. So it's great if a founder of a company is still involved with the company, because it just seems like they're so much more invested. Like, they're thinking about the company in the shower, they're thinking about it when they're driving to work. Like, I just love that, because they're so much more invested in the company. And especially if a huge portion of their net worth is invested in this company, it just, all of the incentives are aligned for you as a shareholder. So I think doing a deep dive on the management, especially the CEO, is really interesting to sort of understand, like, would I trust this person with my money? And that is just I think a big component of our research dish, definitely.
Yeah.
And then
I agree. Maybe I would add something there, because that's very important to understand what the CEO, who he is, and what he is or he or she is adding to the company, because the integrity of that person kind of drives the whole company. So if the CEO is going to engage in kind of unsavory activities, then you kind of have an idea that he's not an ideal person. And then I read every kind of earnings call a lot of companies, and then some CEOs you sit down with, and they're like, you feel like you're in an MBA class with them, because they teach you a lot of the company. They understand their company very deeply. They're passionate about what they do, and they know where they want to take the company. So those kind of people, you're like, okay, I want to put my money alongside this person so that we can grow together. So whatever vision that he has about the company. What do you think about that also?
Totally. I think you nailed it. And you brought up another good point, which you know very well, the earnings calls. And so that's another really sort of zoomed in data point. And I think it's great to sort of either read through the transcripts of the earnings calls or actually listen to them. What I've been doing lately is actually listening to them and reading at the same time. I find that I pick up like little pieces of information that's sort of helpful. And there's some apps that have actually the companies with the earnings call, so you can listen to it like a podcast.
Which
But
kind of
yeah, I
companies,
totally
which
agree.
kind of apps are these? Could you tell us?
Yeah, I don't know how global they are, but there's one that I use called Borsa, so
Boss?
Borsa.
Okay.
That's a really good one. And then you can find it on the company website sometimes, sort of just the webcast
The
of it.
video also.
But yeah,
Okay.
yeah. Um,
So
but yeah, I agree with you that the what you said about the management team, that's exactly right.
So let's keep building up our dish together. So we're adding up the annuals, transcripts, and those stuff. So what else? What else can we dig up a little bit more if you're curious? And I also liked really what you said about letting your curiosity kind of guide you, because you don't want to be reading about boring companies. So you want to read about a company that's exciting. Of course, there are companies where it's boring at first, but then later you get this kind of like spark, like, oh, this is what they really do. Because if you go to a company like Google, at first you may think that they get their revenues from search, but actually when you dig deeper you realize, okay, this company actually gets its revenue from advertisement. So it's kind of a marketing kind of company at the end of the day, ad-based kind of company. So you look at it, if you dig the segments and you find it's two, actually it's just Google and others, and then you realize like Google also has a lot of kind of moving parts in the process. So I like this aspect of where you're saying that the curiosity kind of leads you and guides you, and at the end of the day you never know where the best piece of information is going to be. You may just find it in some really crude corner of the planet.
Yeah.
So
Yeah,
I
that's
like
super
that.
true.
So you're kind of building a web. It's your own little web, like a spider. You're kind of doing that, I think. What do
Yeah,
you think about
exactly. I mean, some of the best pieces of information I found on like some obscure blogs, or there's this website called Reddit where
yeah.
somebody has like really in-depth, knowledge of the industry, and like maybe one comment on it. Like, just you never know exactly where you're going to find a great piece of information. But another thing that I think would be important to add is competition.
Yeah.
So understanding what are the competitors of this company, and sometimes they will specifically tell you who the competitors are in the annual report, but other times you have to be creative and do a bunch of searching and find out exactly who the competitors are on your own.
Mhm.
And sometimes there's different review websites. So for a lot of software products, it will be, this product versus this one, and then a company will objectively compare the two. And reading through a lot of those reports, in the US, there's a company called Gartner, which compares a lot of the technology companies. So maybe even reading those reports, but really understanding what's the level of competition that this company has. Because just the law of microeconomics is that if a company has outsized profits, there's going to be natural competition coming in and trying to take those away. So a great sign is if a company has been around a long time and they really don't have that much real competition. And so I say real because a company will always have competition. I mean, there will be little companies that will be doing a similar thing, or there's other companies that seem like they're doing the same thing. But I think it's important to understand like the real level of competition, like how worthy is this competitor. And you can find out, that if the competitor is actually publicly traded, you can do the same thing. You can read their annual reports, you can put together their financials, and then sort of compare the two or the three or the four, and understand like who's actually the leader in this space, who has the best profit margins, who has the best growth. And once you kind of understand like, oh, there's a clear leader over here, then you can sort of then ask yourself, why is that happening? Is the management team way better? Do they have this particular piece of the customer experience that's just way better? Is there a structural reason with distribution that is the reason? So you can sort of once again let your curiosity guide you to sort of understand why the market structure is the way it is, and who's really the leader.
So now I want you to link that to the idea that Warren Buffett talks about a lot, about the moat. Like, this is a company's moat. you've built, why is that important in this case now? Why should we understand the idea of a moat in relation to the competition in the kind of things that you've just talked about?
Totally. So another word for moat is competitive advantage. And so, what sort of advantage do you have that your competitors, it's really difficult for them to replicate? And so that kind of goes back to that competition and not allowing them to sort of, make your profits smaller and smaller. Because at the end of the day, the value of a company is how much cash it can essentially return to shareholders. Either in retained earnings, how much cash the company can really generate. And so if you have that idea in your mind, you obviously don't want the amount of cash to dwindle over time, because that's the value of your company. So if you think about it on really those basic principles, competition is a huge piece of that. And then you sort of drill down a layer deeper. You want some sort of advantage that disallows the competition from dwindling your cash over time.
So like
And
this
so
protective,
this protective sort of moat that's around your business. Which it's pretty interesting these days, because like the moats of the old days, it could have been just like hoarding information, where I'm trying to think of like a good example, like maybe Bloomberg, where it services a lot of wealth managers and hedge fund managers and has the best source of information, and it doesn't share that information. So that it's sort of an interesting ability for that company to hoard it. But now with the internet, there's so much transparency, which Bloomberg's still doing great, but I think like the definition of a moat going forward will change a little bit. I think it will be a little bit about resilience and how innovative this company is. There's some guys that I'm friends with. They run a fund called NZS Capital, and their whole idea is that resilience is actually resilience along with a moat is actually very interesting. This sort of concept of how adaptable is the company, but that I'm kind of getting ahead of myself. A moat is there's a few like generic categories.
Could you give an example of a company that is maybe global so that people can relate to? Because in Kenya, I would say there's a company called Safaricom. They've been mobile service providers since 1995. They've had a lot of competition along the way, but right now, I think they own up to 70% of the kind of market. They've been able to evolve over time, but at the same time, they're very innovative and evolving over time towards a competition. And the thing is, if you have your SIM card with this company, at some point you couldn't even teleport it like to another provider. So they hold you. At the same time, they have the best money transfer service in Kenya called M-Pesa. So if you link those two, there's no way people are leaving this one for the competition. So it's like a moat, you created it there. So like, could you tell of a company, maybe Coca-Cola or something like that, which has a moat where you can see like, okay, this is something that distinguishes it from the competition and makes it so good at what they're doing?
Yeah, that's actually a really interesting example with Safaricom of that switching cost. So switching costs is an interesting category of a moat, where you said like the SIM card isn't even compatible. So you have all your data and maybe even your contacts on the SIM card. And so for you to actually change providers, that would be a huge pain. And so that level of pain, like the higher that level of pain when you switch, the bigger your moat essentially. So I think that's a super interesting example. Like another category is sort of network effects, which is talked about a lot, but a good example of that would be Facebook. So basically each new person that's added to the network, it increases the value for everybody else. So, when a friend joins Facebook, that's better for you. And then the thing about that is once a ton of people are added to this network, you don't really need another network, because you can do all your sharing of information. You already, sort of have an identity on this platform. And so it becomes pretty difficult for upstarts to sort of dislodge this company, especially since they have this huge network, and especially
I'm
maybe Facebook.
smiling because I think in Kenya, the company with the greatest kind of a network effect is also Facebook, WhatsApp. WhatsApp is like a lifeline in Kenya. So like everybody is on WhatsApp. So if you want to communicate, if you want to have like a wedding, you invite all people to small group. So like the switching cost to any other network is very high. People don't, and WhatsApp sometimes comes free together with the SIM card from Safaricom. So they tell you, okay, we give you free. So it's very kind of integrated. So I would want to tell the listeners also that they can send in questions. I have some questions here. So I will ask you a couple of questions towards the end.
Okay.
But maybe I've exhausted a lot. Is there something you wanted to talk to us maybe about how to build a good portfolio? Because yes, you've talked about all this. We started from maybe Colgate. We have now Colgate in our portfolio. We've included Zoom. So we feel like, okay, Google is in there, Apple, maybe we have 4. So we have a small portfolio. Why is it important for an individual investor not to put all my money perhaps in Google, but to also like, spread it around, and at the same time to make sure that if Zoom ever goes out of the market, at least I have, I have Google here for me. So like, why is it important for someone to have that portfolio, and how can you build, coming to our topic today, how do we build a resilient portfolio for tough times like in the COVID-19? So that's maybe you can share a little bit more now.
Totally. So yeah, there's this sort of tension between diversification and concentration. And what you're describing, diversification, basically, yeah, you don't want to put all your eggs in one basket. Like even if we really believed in Google or Facebook, if we put all of our money in there and then something totally out of the blue happened where, the CEO stepped down or they made just a really terrible decision, we could lose a lot of our money at one time. And so we obviously don't want to do that. So a great way to sort of diversify our risk against that is sort of adding more companies to the portfolio. And the other thing is you don't want too many companies because then it's really hard to follow them and know them really closely. So I'd say like a great range is between 10 and 20. I think that's pretty solid because you get enough concentration where if one company does really well, it will benefit you greatly. And if the other one, or if another one in your portfolio really doesn't do that well, it won't hurt you all that much. So that's definitely one piece of it. You don't want to just put all your eggs in one basket. But then the other piece of creating a resilient portfolio is really understanding the companies. I think this is a piece that isn't really talked about enough, because if you knew absolutely everything about the company, then you would have an advantage in being able to sort of understand it versus other people. So just like one very practical thing is understanding like the balance sheet of the company. And this is sort of the assets and the liabilities of the company, meaning how much the company owns and how much it owes. So if it owes a lot more than it owns, then eventually down the road, the creditors and the people who want their money back are gonna make sure that they get their money back, and that's not great for the company, especially if they're not doing well. So it's important that the company has cash and that their debt load isn't too heavy for the company. So there'll be some very strong companies that have a lot of debt, but that's because they're very predictable. But what we've seen with COVID-19, there's been some companies, especially like airlines, restaurants, where they could never have foreseen that the revenues would essentially dry up because of the quarantine orders and all of that. So if they had a lot of debt and now they have no cash coming in, all of a sudden the company is in a really precarious position. So I think that's definitely one piece of creating a resilient portfolio, making sure that your companies can withstand recessions, withstand really bad things, even flukes that happen. So that's just one practical piece of advice.
How many stocks are in your portfolio right now? If you were to audit you, like
right now they're
plan
10.
To share 10. I have 5 to 7 also. So like it's a very small concentrated portfolio also. Like the reason why I see what you're saying, it makes a lot of sense, is because you don't want, like when I had, at some point I had like 20 companies, and I realized like you spread it so thin such that even if one stock goes up, you don't have a lot of money at the end of the day. So you want like 5 to 10 companies that you can follow, and like you read, or you almost create a Google alert every time something is happening about the company.
Yeah.
You have information happening, so that you can quickly change your portfolio. And also sometimes, do you also go through your portfolio and say, okay, this one has achieved its goal, this one is too expensive, maybe I should get rid of it, or this one has been losing money for too long, maybe it's time to cut off. Do you do that also? Do you cut and chop here and there?
So I tried to minimize trading as much
Okay.
as possible,
Why is that?
because yeah, I think that I've just seen and studied my returns over time, and I've really found that usually the best course of action is to do nothing, like to buy really great companies and ones that you really know super well, and then sort of just let them ride over time. So I'm actually more apt to buy as the company does better over time and the stock actually increases, rather than the company reports a really bad earnings report and the stock falls, and then I buy more because it's at a lower price. It kind of goes against this sort of, buy low, sell high mentality. But I think it really, another factor is the time horizon that you have. So if you want to hold these companies for, 5 years, maybe even 10 years, it's pretty likely if you own a good company, the stock is going to rise over time as the company keeps performing. And so you sort of know the company better, and your thesis is playing out. You know why the company is doing really well. It might make sense to put a little bit more money behind it. It's sort of like, I don't know if you guys follow basketball, but if you had a player who was doing really well, was scoring like 30 points, and all of a sudden you took him out at the, in the fourth quarter, like that kind of wouldn't make sense, because he's doing so well and you really believe in that person's talents. It's sort of the same with companies. If they're doing really well, it doesn't make sense to, bench them by selling them. So that's sort of how I think about it. Peter Lynch, which is a great fund manager, he talks about it, saying like, you don't want to pull your flowers and water your weeds. You just kind of let the best companies sort of perform for you over time.
Yeah, definitely. I agree with you, because I think lots of studies have been done, and a lot of the returns that investors could have made are lost in terms of you trading from one stock to the next. Like right now, the most popular stock around is Tesla. And I saw like a lot of people are piling into it. The problem in those kind of hyped up stuff is that they fall back to earth. Like a couple of months ago, there was a Beyond Meat that was also skyrocketing, and then suddenly people are not interested anymore. So I think trading in and out of stocks, and I think that's a philosophy you and I also we abide by. We do not want to be day traders. I can tell you that the times when I've tried day trading stocks, I've lost a lot of money in the process. Like
Same.
I can't, and then the stress is also a bit too much. I remember like one time I bought a stock, and then I know that this stock like moves up very volatile during the day, but then it can end up to almost 3 or 4 times the price it started. So the thing is, the problem with that is that you're always stressed, looking at your phone, like wondering where is it at this moment. And then you enter a meeting, and then at the end, the first thing you want to look at is the stock again. So it's very stressful, I think. So I think our philosophy, I think, is that we want to buy a company for the long term, I think. So I think unless you have something, I can ask the questions from the audience now a little bit. Did you have something to add?
Some questions.
Okay. So here is a question from Sharon. She says, how much would one invest in a company if you say have 5 companies in your portfolio? Should you target around 1,000 shares, less or more? I think most of these are small scale investors. So what would you advise? Like, what's the appropriate number of shares? Like, are you dividing, 5 shares each, or like I have $1,000, maybe I should put $200 each? What's the appropriate way to look at it?
Yeah, that's a good question. I think it's important to sort of make sure that it's practical. Yeah, if you're starting out with a small amount of money, just like I did, I don't think it makes sense to have 20 companies, it might make
Yeah.
sense to sort of have a smaller number of companies. Maybe you start out with 5. It might make sense to just sort of spread them evenly. And then as the companies progress and one company seems to do really well, it becomes naturally a bigger piece of the portfolio. And then maybe you can add another company over time. But it really depends on how much money you have. I'd say that there's not really a hard and fast rule, but I think that makes a lot of sense. Maybe evenly splitting it between 5 companies just to start, making sure that you don't go too big, too fast, so that you have so much information to keep up with. I think that makes a lot of sense.
The other question here is, how can you identify a good and a best and yet competitive industry that is growing and listed, but it has potential to grow? So I think the question he wants to ask is, how do you what makes a good industry to identify? And I think I would want to link it to the thing you said at the beginning, that a good industry is also the industry that maybe you're most interested in or you work in. It can be a good area to start because you know it best. You know, if you're a doctor, you know biotech better, because when I read biotech companies, I get lost and I actually have to ask my friend, what does this mean? So if I read an engineering companies, I always talk to my engineer friend to get a little bit more insight. So link that to that and then answer, like, what would be the best, what's a good industry to start in, I'd say.
Yeah, I mean, I think there's 2 aspects to that. The first one, as we've talked about, is sort of, your circle of competence, what you're interested in, what you know really well. And then there's another piece where just some industries actually lend themselves to better returns because of barriers to entry or because of like the economics of the industry. So there's some industries like restaurants, which are historically really tough businesses because people want to start restaurants. There's always new competition. And then another is like oil and gas, very sort of tied to the price of oil, which is very hard to predict. So it's just very difficult to know what the future is going to look like. And then there's some other industries like healthcare and medical devices, which historically have done very well because, it's high technology. It's hard for a lot of competition to come in. There's switching costs associated with the doctors learning new tools.
They also, I think, a lot of patents also in the process.
Yeah, patents, exactly. So, with that said, you could know a ton about oil and gas, but it naturally is a much more difficult industry. So there's this idea of naturally expanding your circle of competence. So maybe you know a lot about oil and gas originally, but slowly you understand more about healthcare and maybe consumer packaged goods and some other industries that have historically done really well. So I think just keeping both of those things in mind, but it's great to start out with the industry that you know pretty well.
I'd say it's also good to, I think some Michael Mobosin talks about base rates. So it's good to know the industry that you're in and what kind of returns have they had over time, because tech companies are known to be like they skyrocket over time. Healthcare companies also, like, they perform very well, but there are also industries like where the industry currently, like I'm interning at a beauty products company, the margins are pretty low. Like if you're doing retail, the margins are very low, like 5% margins, but then if you're working in some other companies, they're very high. So like industries, I think, let also your curiosity read you, but at the same time also look at the base rates and like, okay, which industry tends to do well, and see and maybe select the best companies. So to tie that to that, someone is asking about what business models do you see going forward that are most resilient, that we can, and companies in these resilient kind of models that you're looking at, that you would be interested in?
Yeah, I think that's a really timely question, because I think,
especially of the pandemic also, because right now more businesses are evolving a lot.
Right. I think one great thing is if a company can have a recurring source of revenue. So for instance, like Zoom, if a big video conferencing system, every month Zoom is going to get billed, and as long as Zoom is doing a great job, they're going to continue to get billed. They don't have to go sell another product. For instance, if you sold refrigerators or something, in order to get to your same level of profit last year, you have to go sell the exact same number of refrigerators. And to grow, you have to sell more refrigerators. Versus Zoom, they have that same client base that is just recurring, and then they just go sell to new enterprises. So they don't have to worry about kind of reselling and making sure that everybody, it's kind of this automatic process. And there's that dynamic in some medical device companies where it will, like for instance, robotic surgery. There's this company called Intuitive Surgical. They have these Da Vinci robots that enable surgeons to do very minimally invasive surgeries. But then the arms of those robots, they have to like replace every so often. And there's certain consumables that they talk about that are recurring. So if the doctor does this amount of surgeries every month, then they have to buy new arms or new little fingertips of this robot. And so it's very recurring in nature, which I think there's just an advantage to not going and having to sell constantly, because that leaves more probability that somebody won't buy.
Yeah, I agree with you, because businesses with recurring more, especially revenues, are very resilient in tough times also, because sometimes the consumer doesn't even notice that they're being deducted every month from this kind of stuff also. So I think those kind of businesses they're built for the future, I'd guess also. And the other thing I've also noticed during this pandemic is that businesses that have recurring subscriptions, the subscription is going to run, let's say someone has taken a subscription for the whole year, so it doesn't depend on the pandemic, kind of it's running until next year. And there's actually sometimes they don't even need to do anything, it will still roll over, kind of something like that. And once you have this customer, then you've kept them. If they're here, they're not going to leave. So those kind of businesses, I like them also. And for me also, the other kind of companies I look at, companies behind companies. Like there's a company called Twilio. They do messaging services for Uber and for Netflix. So when you lose your password on Netflix, they're the guys where the message comes to your mobile phone or something like that. So that kind of a company, it's behind the infrastructure of other companies. And because of that, they have a very good and defensible moats, kind of. So I've seen Twilio grow, and I'm sad that I left it at some point, but it's been growing over time also. So I think those are kind of good companies. So another question that's coming: how do you allocate your portfolio across? Do you diversify beyond stocks, say to ETFs, bonds, cash, and what percentages do you put there? Real estate, gold, Bitcoin. And I know this morning Twitter got hacked, and then Bitcoin had to go around a little bit. Do you also try and put your money in those kind of places you don't understand fully, but just for diversification effect? And what percentages of your portfolio goes into all these places?
Yeah, I think it depends on your age. So I think if you're very close to retirement, it probably doesn't make the most sense to be full tilt in stocks and nothing else. But if you have a really long time horizon and you look historically and think that stocks have returned, it's been the best asset class over time, it probably makes sense to have most of your money in that asset class, which has done super well. So yeah, I don't have any index funds or ETFs or bonds. I try to keep some cash on the side just for living expenses. Exactly. Make sure that I don't ever get in a cash crunch. So that's really important. But when the money in my portfolio, I typically try to keep it fully invested, because if there is a huge downturn, I have some cash on the side, but I don't typically count that cash as part of like my asset allocation. That's sort of like emergency fund, or have a little extra in case the market really crashes and I feel that there's some good opportunities. But most of the time I try to stay fully invested, because if you look at the numbers, over time the stock market has gone up usually like 2 out of every 3 years. So probabilistically it makes sense to have your money fully invested, because if you have 50% cash, it's basically trying to time the market. And it's very difficult to time the market and get it perfectly, because you have to be right on the sell and you have to be right on the buy. And I can't even be right on one of those. So I just typically try to make sure I take that piece out of it and try to just stay fully invested for as long as I can.
Yeah, I agree with you. I have a slightly different approach. I have a little bit of cash on the side, especially lately when I've seen like valuations that are a bit too crazy. So I've kind of like toned down a bit, but I am like 50% invested right now. But the other part is not because it's also because I can't see good ideas around. So sometimes you can just chill waiting for a good idea around. But I agree with you. I think market timing, and I think that also leads me to, I can ask you a question about that. How do you manage your emotions? Because I believe 90% of success in investing is a lot about managing your emotions, so that on March 23rd, when you wake up and the stock market is 20% down and everything is red, and you bought this stock and it's been a couple of months and it's red, I don't know why they also put like when it's down it's red, so it kind of triggers in you that desire to want to click sell immediately. So I feel like how do you manage that emotion so that when everyone is panicking, because I think that's what Warren Buffett says, when everyone is greedy, you want to be the calm one. When everyone is calm, then you want to be a little bit greedy, something like that. How do you manage your behavioral investments? And also you can also speak a little bit about your investment process, so that you don't so that those rules you set up rules from before, like I wouldn't sell until this, so that it guides your performances later. How can you say about that?
Yeah, I love that you brought up the colors of the stocks, actually, because this might seem really intense, but I actually don't have any color on my phone just for that reason. So making sure that I don't actually see the red or the green, because it does elicit sort of this emotional response. So I try to do little things that help me as much as possible, because it's definitely difficult. But one thing I think that is really underrated is just understanding the companies very well. So if you understand them super well, and then you see all of this bad news coming in, and it feels like just you're overloaded with information, you can kind of go back to the drawing board and say, why do I hold this company? Do I think it's going to be more profitable in 5 years? Just sort of taking the zoomed out view of it. And I think that will allow you to sort of regulate your emotions. Because if you just say to somebody, hey, make sure that you don't, buy high and sell low, but they have all this information coming at them that would actually make the most sense. Because a lot of people say like, oh, when this next thing hits, I know I'm going to buy low and I know it's going to be great. But when you get there, there's a whole nother set of circumstances that are affecting other people just like you, that is forcing the market to go down. Like, that's the reason why it's going down, is because people just like you are selling. And so you need some sort of differentiation. And I think that is really understanding exactly why you hold the companies. And that's another reason why, holding too many companies can sort of be overwhelming.
What's your investment process though? It's quite difficult, I must agree, because on 23rd, I remember the period was the end of March, when everybody is panicking. I mean, you want to sell also, but then the next week the market has been bouncing ever since. So it's really hard like to point out and say, but what's your investment process like? How do you, so that you able like to defend yourself a little bit from this kind of, what's your rules for selling and buying? Or if I could ask like that.
Yeah, buying and selling, it's definitely difficult. I usually try to make the buys somewhat automatic. So over time, like I'm a fan of dollar cost averaging, where I typically, like, quarterly, I'll buy new stocks, or add to the existing ones, and just do that over time, so I don't have to sort of time it perfectly. And then on selling, ideally I'll try to sell as little as possible, but there's sort of like two practical things. Like, if everything is red, there's a better chance that it makes sense to buy on that day, versus if everything is green and one stock is really red, there's like a better chance that maybe that one stock, there's something sort of iffy with that. versus if everything is green, like everything's getting bid up, probabilistically, it's a better chance to sell on those days versus everything being red. So that's sort of how I think about, I mean, not that I see the colors, but like if everything is negative, I guess,
Yeah,
or everything is
understand.
positive, it's
So
just like a good thing to check yourself. Is everything negative or is everything positive?
some quick questions here which you can answer. Like these are quick ones. Favorite book on investing?
One Up on Wall Street by Peter Lynch. I'm a big fan of that. Kind of goes into like observing the world around you and a lot of things I've been talking about.
Role model? Your role model?
It's pretty interesting. It's hard to say. Like investing, I'm actually a big fan of this guy named Stanley Druckenmiller,
Okay.
who is a very different investor than I am. He's sort of like a macro guy where he looks at a ton of different stuff, but I think one reason I really value his opinion is he's very willing to change his mind when the facts change. He's not afraid to hold on to a belief because of his ego, and I think that is a really important piece of being a good investor.
And what advice would you give relatively new investors? Advice to new investors? Quick 1 and 2. Off the top of your head.
I think really looking inward and asking yourself, do you have an interest about business? Because there's definitely it's a competitive industry, and if you don't really enjoy it, then it's going to be hard to do well. So I think honestly, just going back and sort of being introspective about that. But even if you don't necessarily love it, sort of finding companies that you are interested in, I think it goes back to interest, because then you'll naturally be curious about it and you'll naturally know more than the next person about the company.
Do you ever consider capital gains, dividends, payouts, stuff like that? Like allocation in companies?
A good question. So dividends are interesting. I typically don't invest in companies that have dividends. That's not necessarily like a hard and fast rule, but one thing is the company gets taxed on their income, and then you get taxed on your dividends. So it's sort of like a double taxation thing. And then the other thing is, if a company's paying a dividend, they likely don't have as many reinvestment opportunities. So I like companies that are really investing back in the business and trying to grow the business for the longer term. And then capital gains, I don't know exactly how it works in Kenya, but in the US, it's if you hold a company for more than 1 year, you get taxed at 15%. But if you hold it for less than 1 year, it's 30%. So ideally, that's another example of why you want to hold companies for the longer term.
I didn't know that, because I think it's slightly different in Sweden, but I don't know. I haven't studied exactly the Kenyan market, so at some point maybe we need to bring someone. So I have, I mean, the questions are out, but I have 2 questions for you, perhaps. What's the biggest mistake that you've made in investing, and what did you learn from it?
I've definitely made a lot of mistakes. I'd say there's been there's been a lot of things. I think one thing that is like, there's mistakes of commission and omission. So omission means like you should have bought this stock because it went up 10x and didn't. And then commission is you bought this stock and it did really poorly. So I've made a lot of omission and the errors. And the thing is, you can't win them all. Like, especially if you have a concentrated portfolio, there's just going to be some stocks that you simply miss, and it's too bad. All that really matters is the companies that are in your portfolio. So I wouldn't stress too much about like, oh, I should have bought this stock and oh, I missed out on this one. It really matters about how the companies in your portfolio are doing. But for commission, there's been anytime I outsource my thinking, so I trust somebody else's conviction and I don't do the necessary work to get my own conviction. Like, there's a good quote, you can't borrow conviction. And I think that's super true. And just being able to understand it yourself. There's like, just to give a name, a long time ago, probably 6 years ago, I bought GoPro because I thought it had an interesting brand. It's like those little cameras. But it really wasn't defensible. Competition came in and sort of eroded the margins. So that moat that we were talking about, it just wasn't as strong as I thought it would be.
Yeah, I agree with you. Like there are a lot of companies. I have this, even though I don't invest in all stocks, I also have like this watch list where I keep some stocks which are interesting. And I've noticed like some of the companies in the watch list have grown over time, like significantly. And sometimes it's because you don't have enough money to invest. You can't invest in everything. So there will always be some investments you will miss.
Totally.
And it's okay to miss out on them. Like the FOMO shouldn't drive you too much. And also, I think also like one of the other things I've also learned is that it's only 1 or 2 or 3 companies in your investment portfolio that is going to drive most of your investments over time. So it's not like all the companies are going to perform. There's always going to be a bad performer. So you don't have the crystal ball to pick the companies that are going to succeed. If we did, we would not be here. We would be secretly plotting the next companies that are going to dominate the world.